You've reduced your return on equity target to above 15% from above 18%. Now that's a bit of a blow. Is it the business model isn't working?
Well, we actually have revised our return on equity target down from an 18% target to a target of above 15%. This is really to reflect the new environment, to reflect the new capital requirements. Obviously in Switzerland, we do have a proposal on the table for significantly higher capital requirements and really the new environment. So our view is that that's a very healthy return on equity.
But what
that'll be among best in class in the industry, and so that'll be something that we think is a very healthy return over time.
But what changed since October? Because then you were still looking at above 18%, but we'd had the proposals for the new capital requirements from the Swiss authorities since then. What's changed?
No, really, the new capital requirements came in the fourth quarter. We've obviously, looked at those capital requirements, looked at how Basel III will work through, and we've basically come up with what we think is a very thoughtful but also sustainable view of return on equity in this new environment, which is greater than 15%, which, as we say, we think would be, a very strong return, best in class among global banks.
Your dividends come in at 130 Swiss francs. That's below the expectations. Do you imagine that dividend's going to stay at that sort of level because you're going to have to build up capital?
Well, first of all, it is a capital distribution, so it's tax-free in Switzerland. So particularly for the retail Swiss investor, it's actually the equivalent of a higher gross dividend. But yes, our view is that that's a sustainable level of dividend. It's one that we want to maintain and grow over time as we do accrete capital and as we move forward.
In the wealth management business, net new money coming into the business, we're looking at something like 14 billion Swiss francs. Do you expect, that was for the fourth quarter, do you expect to be able to maintain that momentum into 2011?
Well, look, in the fourth quarter we had close to 10 billion in our wealth management business. For the full year, we had close to 70 billion. Since 2007, we brought in 200 billion in net new assets in our business. This is by far the strongest record of any private banking business. And our view is that hopefully that momentum will continue. We think we've got a lot of good momentum. It shows the faith that customers put in our franchise, and we hope that'll continue.
UBS has said that they're expecting to see significant new money flows coming into their business in the private banking this year, albeit from a small base. What's your forecast for new money flows coming into private banking at Credit Suisse?
Well, we've set a target of 6% net new asset increase over time. We've met that target, pretty much met that target over the past period of time. And as I say, if you look at the full year 2010, I mean, to be close to 70 billion of net new assets coming in, that's a very strong performance.
What are your clients doing with their money at the moment? Back in October, you mentioned that about 30% of that was in cash. Is it the same now, or has it changed?
I'd say it's probably moved slightly down, probably moved a little bit of money out of cash into the equity asset category, but it's a relatively small movement. But there's probably been some slight movement towards that.
Do you, would that account for the equity rally that we've had, or do you think that that's something else that's driving the rally? Is it the money coming from QE2?
Well, I mean, obviously, I'm not sure the exact origins of the rally in equities, but certainly I think there is liquidity going into the equity markets.
How's business looking in investment banking at the beginning of the year?
Well, we've had a strong start in 2011, but obviously January usually is a strong month in the business, and we've got very strong pipelines, so we'll see how those play out. Obviously, to predict a quarter, let alone a year, is a difficult thing to do, but right now things do look pretty strong.
Do Switzerland's even stricter rules on capital ratios, is that going to have any effect on where you decide to locate some of your investment banking businesses?
Well, as you know, we've got among the proposal in Switzerland is for two parts of the capital structure. One is a common equity base, and then there's the contingent convertible or buffer capital on top of that. We continue to believe that the buffer capital, the contingent convertible market, is something that is going to be a very viable market over time and will actually be readily available to firms to raise money. Obviously, we have a lot of capital already. We ended the year at 17.2%. So our view is we've got a very sustainable business model as it is. We think we can continue to drive this client-focused and capital-efficient model going forward, so we don't really see any major need to change the configuration of the business.
Some analysts say that within investment banking, stricter capital rules are going to mean that businesses like fixed income is going to become less attractive than equities. Would you agree with that?
Well, I think that's kind of a broad statement. I mean, it depends upon which businesses you're in fixed income and how they're pursued. So for instance, our model, which focuses on client flows, which focuses on rapid asset turns within that, we think is going to actually fare quite well. Now, there will be adjustments that have to be made as Basel III phases in, but overall, we think fixed income will continue to be an attractive business.
So what are you doing to beef up your equity business over the longer term?
We've got a very strong equity business. We've got top market shares in our equity business all around the world, so it continues to be a very, very important business, and it also has very good returns the way it's configured now, so it continues to be an important business.
In terms of headcount and investment banking, you happy where it is, or do you need fewer or more bankers?
Oh, I think it'll always be a dynamic number. We're obviously shifting within our businesses as well, but I think we'll probably be, at levels that are similar to where we are now.
You've talked about selling contingent convertible bonds sometime this year. How are your plans proceeding at the moment?
Well, we continue to believe that the market will be conducive to raising capital in this form. We think that investors will be interested in it, and so we continue to believe that it's something that is doable over time, and we'll continue to look at where we see opportunities.
If you did do one, or when you do one, will it be to a specific group of investors, like say sovereign wealth funds, or would you do a public issue?
Oh, I think we'd have to look at where the demand was and what the opportunities were. I think we'd look at accessing whatever investor bases were most cost efficient at the time.
What's happened to your bonus pool this year?
Well, you can see in the numbers that we have put out today that our total comp per capita is down 9% from last year. So our total compensation pool per capita is down 9%.
Are you concerned that you might lose some bankers because of that?
We think that's probably relatively in line with the industry. I mean, we did have, we had obviously had a good performance last year, and it performed well this year as well. So we think that actually it's probably competitive pay for that. But obviously it also represents a disciplined approach.
What's the one thing you want to achieve at Credit Suisse this year?
Well, I think we want to continue to focus on executing on our strategy, focus on our clients, make sure that we're really doing an excellent job for them. And I think if we do that, we're going to have, we're going to be very successful in the execution of the strategy.
Brady Dougan, thank you very much.
Thank you.